Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The TSX was the hottest market in North America this week. He talks about what drove it higher and also about the U.S. and Canadian dollars and the sudden drop in lumber. Author of the second edition of the book When the Bubble Burst Surviving the Canadian Real Estate Crash, Hilliard MacBeth, is here to talk about the state of Canadian real estate and what has been driving a huge rise in home prices. He's worried we're about to see a major drop in values and perhaps increasing foreclosures because incomes have not kept up with housing prices. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at Charts by Ross. Welcome back to This Week in Money.
Good to be with you, Jim.
Ross, the Toronto Stock Exchange, the hottest in North America this past week.
It surely is. I mean, I think it was every single day was an up day. After having the Monday off, they had to have a bit of a holiday here. But these Canadian stocks, the financials, the banks, just coming out with great numbers, and you've got the energy market doing reasonably well. Not as strong as it was a couple of weeks ago when things were really racing along, but yeah, this Canadian market doing very, very nicely, broken out of a long-term consolidation pattern if we go back and look at it here, but probably getting a little bit ahead of itself, and it never hurts to take a little bit of money off the table when everybody's pounding the table about how much money they're making.
How's the Canadian dollar doing?
Canadian is just biding its time right now. We've been looking at this one, starting about 2 weeks ago. Started to get some really good overbought signals as it got up to the 83-cent level. And the commitment of traders numbers, there we see that the speculative long positions and the commercial short positions are at levels that generally produce an interim high. So for all that the commodities helped the Canadian dollar during the first half of this year, the pause that we've seen now in lumber prices and in grain prices, I think is, taking a bit of the shine off the Canadian dollar. And from our perspective, a correction here back, we're at 83, so anything back, I would say 80 cents or lower is going to be, I think, a reasonable correction at this point. And the big base pattern that we've been into, it's about a 5-year long base, could support a much bigger move over time. But I think in the short pull, one needs to be looking at a correction.
$6 trillion U.S. budget. Any market reaction to that?
No, I mean, this was well advertised. I don't think there were any big surprises. The biggest surprise was if they could have found a way to actually balance the numbers. That seems to be the hard part of it. So, even the Democrats are looking at the budget itself and having a hard time figuring out how they would make this thing work. So, stock markets in the U.S. Basically just biding their time here this last couple of weeks. We had that nice oversold pullback at the beginning of May, and I think that we're still talking about the movement into a July-August high. That's the norm in this first year after a presidential election. And so I would suspect that there's probably one more decent correction coming, like the one we had early in at the end of last month into early part of this month. Probably got another one of those coming before we get through the seasonal high. And it's one where you got to be selective in terms of what you're looking at out there. 2-3 weeks ago, we were getting great oversold readings in most of the green stocks, the ESGs. You got things like Fuel Cell Energy, Boralex, Plug Power, Ballard, Brookfield Renewables. All of these were really down and hard oversold. We got some very nice buy signals, and I think probably the smallest performance on any one of them is about 7%. The average is more like a 20 to 25% move in this last couple of weeks. So even though the stock market, the general markets are making this consolidation and just testing the highs, the action has not been that big. But for the ones that have been down and corrected, you're seeing some decent price action.
The U.S. dollar, how's it doing?
Yeah, the U.S. dollar had a good bump up in the middle of the week, closed off pretty much in the middle of its trading range. It's in a downtrend since the April high. The index had been up at 93.5. It's now down at 90. At this point, we're still in a weak seasonal period. I wouldn't be at all surprised that we take out the lows that we put in back in January. That'll put an upside bias to some of the items like the gold market, where gold's had this nice run up through the 1900s, and looks as though a bit of a pause here in terms of the gold, and could be a pretty decent summer for that sector.
How's crude doing?
Crude, we've the norm. It's actually, we're up to $67, which is a good number. We've gone through this really nice movement since April of last year, where pretty much an uninterrupted move. There was a small pause in the summer, but this uninterrupted move that we've seen, typically, and we've got 6 of these if we look at this century, since 2000. 6 times we've had these nice steady moves, and at about the 10-month to 12-month period into the move, you get a consolidation. It moves sideways, tests its long-term moving average. We use an 89-day moving average, and then it comes back to life again. And that's exactly what we've seen this time. The rally that took us up initially to about $62, $63 had a pause into the middle of March. That was the 11th month. Been moving sideways ever since. And just the beginning of this week came within $1 of that moving average support, and now is popped to life at the end of the week. The norm here would be that this rally will have upside bias once again, now taking us into a window that could be as early as the middle of July or as late as October. So we've got a nice window here that's a minimum of another 6 to 8 weeks on the upside. Could stretch through the summer. We'll take a look at the technicals as the market progresses here, but there's a pretty good stretch right around the corner here.
Ross, did they cry timber in the lumber yard this week?
Yes, they did. The lumber price has had quite the bit of action in this last month or so. We were at 1,700 as far as prices were concerned at the beginning of the month. We dropped down to 1,200, bounced to the beginning of this week to 15, and now we're back to 1,300. So what you've got is a pretty good-looking top. All the excitement, the euphoria when we were at the top end, people joking about how much an effect it was going to have in terms of housing prices, construction, etc. And then we, from that exhaustion high, you had that good hard pullback. Now the failure to bounce through 1,500, which is would have been a 50% retracement, that leads now to what I think is a pretty good top. And the implication, as we'd written up for the forest product companies, they are probably a pretty good sale. I think you've seen the best you'll see there for a while, and that's part of a normal seasonal run for the forest product companies anyway, from October through March, April, May. So it's reasonable to be looking at that as a top. The other area that had been really moving in the commodities were the grains, corn and soybeans being the big ones there. And we got the big exhaustion signals in 2 or 3 time frames, either daily, weekly, and monthly. 2 weeks ago, they've had good hard sell-offs and bounced back into the middle of the week. That consolidation, this is an important phase for the grain markets, because the seasonals in here, if you don't really start to come back to life and get more than a 60% retracement rally, then the odds favor a pretty hard correction. So this is basically a fork in the road here, where if the consolidation can gain some steam, then you're probably looking at it running into July. If it can't, then I think you're going to be looking at it give back probably a good 50% or more of this 1 year rally we've had off the bottom. So be looking to trade the breakout in the next couple of weeks with the grains. And either way, that could be a pretty decent run.
Is the Reddit shorting game on again?
They seem to be having some fun. AMC has been probably the stock of the week. They managed to run that one. What have we got here? This was a $12 stock just a matter of, a week ago, and traded up to $36 this week and closed off at $26. This is part of the reopening game as far as the economy is concerned, but there's no way that this stock has a valuation that should be anything like that. You take a look at GameStop, same type of movement, but at a lower magnitude. That in the last week and a half has gone from 140 to 270, and on Friday you got a big outside reversal day, so it was a new high for this move and then closed below the previous day's low. So probably seeing that one having run its course, and I think unless you're a day trader or you're trading it over a span that would be a week or less, it's not something for anybody to really be taking a serious look at.
Russ, thank you so much for giving us this update.
It's always nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Hilliard MacBeth, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. His website, MacBethMcLeodPartners.com. Welcome back to This Week in Money, Hilliard.
Nice to be on This Week in Money.
Hilliard, can you tell us what the latest is on how your book is doing and where people can get it.
So it is still in all the bookstores, and it's on the online services like Kindle and the Kobo equivalent in Canada. And I got actually got the royalty statement. Not a lot of money, but I think we were talking about over the last 12 months, it was something like 300 and something copies. So it's basically selling one copy a day, which is pretty. I was quite pleased with that because it's now been it's just past 6 years since the first edition came out. So I think it's gratifying to see it still selling 6 years later because, of course, but I knew that it would be of interest because this is going to be a story for quite a while yet. Because when the crash actually starts to happen, when the bubble actually starts to burst, of course, then there'll be another round of interest in why did it burst and what caused it, sort of thing, and that's covered in the book as well.
What's the best advice for when you start to see the real estate prices that have been skyrocketing start to wobble?
Well, you're not going to be able to tell. That's the problem. There's nobody takes out a billboard and says, okay, the peak. I mean, I thought in 2016, for example, in Vancouver, in 2017 in Ontario, that the peak had happened, and there was a peak, and there was actually a fairly substantial drop at the higher end. And you and I talked about it on the show at that time. And but then there sort of came a, I don't know if this is the seventh or eighth life to this housing bubble, but it's another one came about a year ago when the pandemic recession hit and the government put a bunch of money in the hands of people, and then of course they were given a lot of options in terms of borrowing even more money to buy real estate.
What do you think led to this huge run-up in real estate prices in Canada?
In the last year, it's definitely been the combination of the finance. It's always a combination of finance, availability of finance, and that's, of course, something that the government and the banks decide basically in tandem in terms of how generous they're going to be and how, they tweak it around the edges, but essentially if you have both of you have a job, they will finance you, and sometimes you have to go to the bank of mom and dad, or you have to stretch a little bit, or borrow the money sort of from somebody else, which you're not supposed to do, but it's obvious that people are getting away with doing that. And then so that's on the one hand. And on the other hand is this incredible widespread fear of missing out. It's just actually unbelievable how strong it is, and I've been marveling at it in talking to people for the last six years all over Canada, and they believe it. They believe that house prices always go up. So if house prices always go up, then you're going to miss out if you don't buy right away, right? So if you leave a year or two, then you're just going to be buying in at 5, 10, 15% higher. And then the second thing that comes along with that is that there's no amount of mortgage debt that is bad debt. All mortgage debt is good debt. So everybody seems to know that, borrowing too much on your credit card is bad, but nobody seems to be afraid of borrowing as much as the government/bank grouping will permit you to borrow on mortgages. And of course, it's understandable because when the magic words are heard, you're approved. The buyer, the young couple, it's understandable they would expect that somebody is checked to see whether that's a good idea or not. So they see it as a good thing if somebody in great authority, I mean, the banks have tremendous authority in Canada, somebody in great authority and highly placed, 150 years of experience has decided with all of their computer models that it's okay for you to borrow that much money. It's okay for you with a combined income of $200,000 to borrow $800,000 to buy $1 million house with the $200,000 down payment borrowed from mom and dad. And when the average house in Toronto is $1 million, that's what's been happening.
Does it look like Canadian real estate has topped this year?
Well, I think it gets harder and harder people are stretching. First of all, based on what we just talked about, if most people believe that for the last 5 years, then most people have bought already, right? So it's not like you've got a whole new supply of people coming out of the woodwork that haven't bought yet. that have jobs. I mean, if they don't have jobs, then they can't buy. But if they have jobs, then they've probably already bought. And then secondly, the incomes have just not gone up. Like incomes are up maybe 1 or 2% per year, and houses are up 6 or 7 or 8% on average per year, even including the downturn we had in 2016 and 2017. So the gap just keeps getting wider and wider and wider. Now, the only thing that saved it so far is that interest rates went down. As fast as the gap went up, the interest rates went down. So when you actually got that number, the monthly payment, $3,000 a month, it didn't change that much, even though house prices, 10 years ago were $600,000, and today they're $1 million. The actual amount you pay on that mortgage payment is similar, and so that's what saved it. But the inflation number in the U.S. Last month was 4.2%, and the inflation number in Canada was 3.4%. And everybody's saying it's transitory, but that means interest rates probably need to be higher if it isn't transitory. Then that means that interest rates have to be above the inflation rate, or else somebody's losing a lot of money. And when that happens, then of course that would be the end. So there's a lot of signs that we may be very close to a top. Another thing that hasn't been mentioned much anywhere that I've seen anyway is the fact that often like a very rapid run-up, which like we've had the last few months here, is a sign that we're near the end. As Warren Buffett's saying is, he's talking about stock market, but it's the same in housing. A bubble feels the best just before it ends, just like sex. So
how does the real estate top in 2016 compare to this market?
Well, the top in Vancouver was in 2016, and the top in Toronto was April 2017. In both cases, people very much like now were rushing to buy and bidding over ask and all that sort of stuff. Very similar. The difference, though, of course, is that prices are substantially higher now than they were, probably 20-30% higher than they were back then. So it's tougher today than it was in 2017 to get into bidding wars. And I think people are reaching further. In other words, I hear now that we didn't hear in 2017, 2016. I hear now almost every mortgage application now has a cosigner, or an applicant, usually the parents or the grandparents or somebody, because people just don't have the income in their immediate family, that is the husband and wife. They don't have enough income to qualify, so they have to get another signer, which, by the way, nobody should ever co-sign a mortgage. It's absolutely the worst thing you can do.
Why is that?
Because what you're doing is you're putting the whole, it's almost always a family, right? So there is one option in Canada that is kind of dramatic. It's kind of last resort, let's say. But if you're way over your head, let's say that this Toronto house at $1 million, $200,000 down payment from mom and dad, $800,000 mortgage, and eventually this guy that wrote this book about the bubble bursting turns out to be right, and house prices drop from $1 million down to $600,000. Well, now you've got an $800,000 mortgage on a $600,000 house. If you say to the bank, I'm not going to pay that anymore, that's crazy. It'll take me the rest of my working life to pay off that debt. They'll come after you for the difference. So they of course, what happens is they sell that $600,000 house and they end up getting $500,000 for it because it's a bank foreclosure and blah, blah, blah. So you actually owe them $300,000, not $200,000. And, it's a nightmare. So what you can do is say, sorry, we're declaring bankruptcy. Now, I'm not advocating that people declare bankruptcy, but it is an option. And then the young couple starts over. And in that instance, once they declare bankruptcy and it's settled, the parents can help that young couple get back on their feet. However, if they've co-signed before this happens, there's no option for them to. I mean, they can declare bankruptcy, but then of course, then the bank will just come after the parents because their name's also on the mortgage as well. So it's absolutely the worst thing you can do because it takes away that option in the case of a very violent and sharp drop in housing prices. Hey, but that's possible. I mean, it's happened in many other countries, and so we should protect ourselves against the possibility it might happen here.
Are people waiting until the COVID scare is over to list properties for sale, and what could that do to the sales listings ratio?
Yeah, so the sales, it's starting to pick up now, but for many months in late 2020 and early 2021, there was almost no listings, and so that led to these ridiculous, auctions where people would be bidding above asking and stuff like that because there were so few options to buy and people were desperate to buy. I have a theory. I've never seen anybody say it, but I have a theory that when people were locked down and they couldn't get out of the house, they couldn't stand each other, so they absolutely had to buy a house to get out of the house. But I don't know if that's right. But certainly, if you're thinking about selling, the last thing you want if you're living in the house is to have a bunch of strangers traipsing through your house that might have COVID and might give it to you. So it makes sense that the listings were artificially depressed because of that. And now that something like 60% of the Canadians have the first shot of the vaccine, it looks like within the next 30 to 60 days, quite a few more will have the second shot. Then it'll be easier for people to list, and they won't have to worry as much about the impact of that. But the other thing I think that isn't related to COVID is just that when people saw prices moving up like that, they got greedy and they said, "Well, I don't think I'm going to live. I'm going to hang on a little while longer until I can get a higher price." So there's also seller's greed. There's buyer's fear of missing out, and there's also seller's greed. And the combination of the two is just like pouring gasoline on a fire.
Did the lack of foreclosed properties lead to higher prices? Because foreclosed properties quite often are much cheaper.
For sure, and that's a really good point. It never gets brought up. The closure of the courts means that there's two things going on. The courts just weren't available for people to see. So, when you do the power of sale or the foreclosure, the rules are slightly different in different provinces. But as I understand it, you have to you can't just go and do it. You have to get a court to agree that you've done the right thing, and the court often will actually ask the lender, say, "Well, are you sure you've exhausted all the possibilities? Have you given them a chance, to make it good, but none of that happened during the COVID thing, and people couldn't get hold of the court. So that's one aspect of it that really slowed down. But the second aspect of it, and I haven't seen any evidence of this, but I strongly suspect that the message went from the government to the banks to say, you know what, there's this thing called forbearance. And so you had the 6-month moratorium on paying your mortgage and paying your rent and paying your car payments, and it was never happened before in 150 years that I'm aware, where people were just said, "Oh, don't pay you're forgiven for a while." Now they didn't forgive the loan; they just delayed the collection of the payments. And I think the message went to the lenders to say, "Take it easy, don't be too aggressive trying to foreclose on these people." So and of course the lenders also are thinking, well, in the middle of a recession, we don't want a whole bunch of houses that we have to dump on the market. That's just going to destroy the prices of the market and put more of our people that have borrowed from us into trouble. So, which is what happened in the U.S. in 2007, 2008. So, the banks, combination of the banks plus the guidance from the government plus the lack of access to the courts means that there were very few. But now the economy is recovering. And the people are back on track in terms of the government support programs are gradually winding down. The moratorium on mortgage payments is ended. That means now the banks will get more aggressive. And if the bank suspects that you've been cheating in some way, if you're one of these people where you're not making your payments, if they think you have the money and you're just directing it someplace else, or if they see that the house could be sold for more than the level of the debt, they're going to move very quickly. And often when they finally do move, they want to move very quickly because they want to get the house sold before it drops in value.
The stress test will be tougher in June for Canadians seeking a mortgage and having it insured. What's that going to do? And is it justified?
Well, I just I've got in my book, I've got, especially in the first edition, I think I might have shrunk it a little bit in the second edition, but the first edition, I went through all the changes going back to 2000, 2001. And of course, for the first 5 or 6 years of it, they were relaxing the rules. They were making them easier. And the ultimate was when the Conservative government got elected. I think it was in 2008. One of their very first acts was to take the no, I guess it was 2006. They took the rules of CMHC and they just opened up the floodgates and said 0 down payment. You don't need any down payment, and you could afford 40-year amortization. Well, anybody with a job and a pulse could afford 0 down payment and 40-year amortization because, of course, prices were also much lower back then. And you could see on the graph how the house prices just shot up right around that level, 2006, and then in 2008 came the financial crisis in early 2009, and so the government stepped in and gave the banks a lot of help in something called the Insured Mortgage Purchase Program. And then as we came out of the recovery, as the recovery started, as we came out of the global financial crisis in Canada, and house prices didn't collapse in Canada like they did in the U.S., the government started to tighten it up. So then it went from 40 to 35-year amortization, and eventually you had to make a 5% up. No, they're not particularly tight in the history of, if you go back to 1980s and 1990s, things are much looser than they were back then. But compared to that 0 down payment and 40-year amortization, they have tightened it up. And then in 2016 and 2017, in Vancouver, it was, there were some restrictions put on, landlords, foreign landlords, whether they be from Alberta or from China. There was an empty properties tax, and there was a bunch of other taxes put on in Ontario as well. And then the government, allegedly, they tightened up the stress test. And what was amazing to me was as they tweaked the rules to make it tougher, people just were able to carry on and kept buying. So now, whether they were doing things like getting co-signers of, mom and dad, or getting bigger down payments from mom and dad, or borrowing them from the shadow bankers, which is very possible. And anyway, in some way, they found a way around these tighter rules. So this latest stress test rule that comes in on June the 1st, which I guess is Tuesday of next week, will it have an impact? It might, because also on top of that, not only do you have the stress test, which means, I think most of your listeners will know, means you have to qualify for the mortgage at over 5%, even though the mortgage rate today might only be 2%. But prices have gone up. So what we're hearing more and more now, quite often, is people will bid for a house. They'll put down the down payment, and they'll go to the bank and say, okay, I thought this house was going to be $1 million, but then there were 5 other bidders, so I ended up buying it for $1.2 million. The bank does an appraisal, and they say, oh no, that house is only worth $1 million, because the appraisals, of course, are a little bit behind as well. But now you got a real problem, because the bank says, no, the most we can lend on the value is $1 million. We can't lend on a value of $1.2 million. So the combination of the stress test, which means you got to be able to make higher payments with your income, plus the valuation, the appraisals coming in too low, that's the sort of thing that could be the straw that breaks the camel's back. But having seen these tweaks before, I'm sort of skeptical, and I'm going to wait and see what the actual impact is.
What do you see ahead with the Bank of Canada printing a lot of money and perhaps inflation?
Well, the inflation is already, as I mentioned, inflation has already gone up above 3%, which is quite a bit higher. For a decade or more, we had nothing above 2%. It was between 0 and 2% for a long, long time. And inflation has been coming down basically since it hit, roughly 15% in 1980, 81. And it's been coming down, most pretty steadily ever since then. So, of course, the way inflation measured would be a whole show. We could do all that. We could spend a whole hour on that. But it's flawed, obviously, in the way it's measured. But now the numbers have ticked up above 3% in Canada and above 4%. Actually, what happens in the U.S. is more important, above 4% in the U.S. Now, everybody so far has said it's transitory. But if as I mentioned, if it stays above 4%, then interest rates have to be higher than the inflation rate. The only reason that interest rates can stay down at 1 or 2% when inflation is 4% is because everybody believes it's temporary. And something to do with the pandemic recession or the shortage. There's a bunch of supply chain issues and that sort of thing. So once that dissipates, then the people expect the inflation to go back down below 2% again, and then it'll be fine. However, in Canada, not so much in the U.S., but in Canada, something else happened, which is the second part of your question, is this money printing. So the government of Canada spent $340 billion more than what they took in last year, and in this year they expect to spend $150 billion more than what they took in. And not only that, but the Bank of Canada bought, because it would have been a bit of a problem to go to the bond market and borrow all that money. So what they decided to do was that the Bank of Canada would buy most of those bonds. I forget the exact percentage. It's like they bought 3/4 of all the bond issues of all that. So the Bank of Canada has owned $200 or $300 billion out of that $350 billion. But they did announce a couple of, maybe a month ago, that they're not going to buy the bonds as aggressively as they have been. They'll keep buying them, but they're not buy as many. So that's going to put a real stress on the bond market, and that's where you would see interest rates going up. And the government doesn't necessarily, government does not control that. So, unless they bought every bond that was issued at a really low interest rate, if they leave it to the market to decide, the market may decide, you know what, we think Canadian interest rates should be 5%, and we want to see the bond prices go down to the point where we get 5% on a government of Canada bond, and if that happens, then all bets are off at that point.
Could growing inflation lead to a surprise spike in interest rates?
Well, the only reason I would be surprised in this case, because everything we just talked about, the market knows. I mean, every bond trader in New York and Toronto knows, London, England, they all know about this inflation in Canada and the U.S., and they all believe that it's transitory, is the word they keep using. So it wouldn't be a surprise. But what would be a surprise if, and this often happens, like all of a sudden, one day, for some reason that nobody really ever can explain, even after the fact, all those bond traders wake up and decide, you know what, I'm not buying government of Canada bonds at 2% when their inflation rate is close to 4%. I'm just not going to do it anymore. And it's too risky. And if that happens, then it would be sudden. It wouldn't be a surprise. The surprise would be in the attitude of the traders, and it would be they decide that transitory is no longer the case, and now what we're looking at is an uptrend in inflation that's going to be with us for a while. Which is, not many people were around in the 70s, but I was. I started in 1978. And I remember exactly the same thing happening. The inflation rate was I forget exactly the numbers, but as I mentioned a minute ago, it peaked at about 15% in 81, I think it was. It was much lower than that in 1978. And every time it went up, everybody says, "Oh, it's transitory." I don't think they used that word. I think they said temporary. And then it just kept going. And then eventually they changed and they went the other way and said, "Oh, I think inflation is going higher." And that's when interest rates had to go to 20%. Inflation was 15%, but interest rates had to go to 20%. So we went from a situation like today where interest rates were well below the rate of inflation to where interest rates were well above the rate of inflation. And that was because people started fearing even higher inflation. I mean, it's hard to believe that at 15% people were fearing that inflation would go even higher than 15%, but that's what happened. And they demanded 20% interest rates to protect themselves, and that would be the change. That would be a major change, and that would lead to all kinds of problems in the housing market and the stock market as well.
We'll have more with Hilliard MacBeth right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, what are the first signs of a real estate bubble bursting?
Well, I think we might see, we have heard about this a little bit already, so maybe the signs are already out there, where people make an offer to buy, and when they go to actually close on the deal, they can't get the financing. They fail to perform. Now they can be sued for that, but we've heard actually going back a year. For the last year, I've heard from realtors and other people that sometimes these deals, there's trouble with the closing. And the latest thing, which is probably only a couple months old, is the appraisals coming in too low. And so that's a big problem when you're trying to close on a deal. If the bank appraisal says it's worth way less than what you contracted to buy at, assuming you need the financing. So that would be one indicator. The other indicator that would be pretty interesting in this market would be a surge in listings. So if you see a sudden surge in listing, for instance, single-family homes allegedly are up 20% year over year. I don't know that they actually are, but the sort of like the headline sales, there's always a home or two that sells, 20% higher than the average home sold last year. So that becomes the index. And if a whole bunch of people decided to list their homes because they like the idea of that, and of course, the median baby boomer in Canada now in the U.S. is about 66 years old. So if they're thinking about downsizing, if they're thinking that, my retirement didn't work out quite as good as I thought, my income isn't that great, my kids need more help than I thought they were going to, that $1.2 million home that we live in, we can live in a much more modest home. If we sell our home, we can solve all our financial problems for the rest of our lives and help our kids too. If that attitude were to come out in any big way, that would be a major sign. And I don't know if you'd really have to watch closely because it wouldn't be an announcement saying, there's a big surge in listing. I wrote a piece on condos last November, so that's 7 months ago now. There was a huge surge in the condo supply in Toronto, and people are trying to get out of condos and trying to move to Oshawa into a single-family home. But that seemed to be sort of more isolated to just one type of housing. But if you saw a surge in listings of all types of housing, condos, homes, townhomes, the other thing that's happened, of course, recently is that there's a record number of new homes and new condos and purpose-built rentals under construction. I mean, the numbers are just off the charts how big they are. If they have trouble filling up those properties, either by buyers or by renters, then that would be a really good sign that we're at the top as well.
Following a real estate market top, how long does it usually take for a real estate bubble to break?
Well, in the U.S., that was the best, probably recent example. It was 4 years. So it went from 2006 to 2010. It bottomed in 2010. The stock market bottomed in 2009. The housing market bottomed in sort of late 2010. So 3 to 4 years would be but this bubble in Canada is many, many times bigger than the bubble in the U.S. in 2006 that triggered that crash. The 1929 market now this is stocks. The records on housing the records just aren't that great on housing. Nobody seems to know. But if you looked at the October 1929 to around the end of 1932 was the top to the bottom was 3 years. So 3 to 4 years, depending on how the lenders react, is the minimum. I think the attitude lately with lenders and homeowners is to be what I mentioned before, which is forbearance. Will help you get through. I remember Alberta Treasury Branch in Alberta, where I live, they had these big billboards in 2015 after the oil price collapse, saying, "Albertans, we've got your back." So that was basically what they're saying is, we'll help you get through this. Which basically the only way a bank can help you get through it is to give you a break on the payments. They'll never cancel the payments, but they'll say, "Oh, we can defer them." And of course, all that means is they add it to the value of the loan. So now you end up paying them more interest over time. So if that were the attitude, then that might stretch it out beyond 3 or 4 years, because the 3 or 4 years is more of a sign like what they had in the U.S., where it's just basically millions of people were foreclosed, and there was auctions and dumping. There was auctions in Las Vegas. You could buy brand new condos for like $20,000, $30,000, $40,000, $50,000, and auctions were happening almost daily. So, that sort of thing. And so that if they do that, it can be over within 3 or 4 years. But if for some reason they delay that, then it could be longer.
Are Canadian banks exposed to significant mortgages and HELOC debt?
Well, it's an interesting question because the banks just came out this week with their earnings. So I was looking at their earnings, and there has been a slowdown in other loans. So not mortgages, non-mortgage, non-HELOC loans. So the commercial loans, the business loans, all that kind of stuff, are actually lower than they were a year ago. They're actually quite a bit lower than they were prior to the pandemic recession. So what's happened is the big banks, Royal and TD, I only looked at the two big ones, Royal and TD, they've gone even more heavily into mortgage and HELOCs. And it's primarily mortgages, not so much HELOCs. Although HELOCs did hit a new record here last week at about $260 billion, but that's pretty minor when you look at the mortgages being at $1.7 trillion or something like that. But at the big banks, the mortgage volume was up substantially year over year. I think it was 6 or 7%. And of course now that might not be the number of mortgages increasing. It might be just the size because, as we know, prices went up. So if the average price went up 10%, then presumably the mortgages would be up by that amount as well. So they've shifted their mix to be even more dependent on mortgages. And one interesting number, not to get into too much detail deep into the weeds, but the banks had a return on equity. One of the big banks had a return on equity in the Canadian banking division of 35%, which is ridiculous. For instance, I looked at Wells Fargo in the U.S. It's under 10% in Wells Fargo in the U.S. So how do they get to 35%? Well, what they do is they lend on mortgages, and mortgages are considered, if they're guaranteed by CMHC, they're zero risk weight, and so that means they don't have to keep any capital at all. They don't have to allocate any capital at all to that activity. Or if it's a regular mortgage, they're considered so safe in Canada because Canadians always pay back their mortgages that they only have to allocate about an 8% risk weighting. So a normal loan is 100% risk weight, and if it's a risky business, it might even be 150% risk weight. So that determines how much capital you have to assign to that activity. So as they've gone more and more into housing and mortgages, they need less and less capital, and the profits on mortgages are actually fairly skinny. But when you divide it by basically almost zero capital, then the return on capital theoretically could be infinite, right? But it's actually 35%. So that's a sign. So no wonder they're gravitating towards that. Overall, the bank was, the Royal Bank, I think, was 17% return on equity. But the Canadian banking division, heavily weighted by mortgages, with 35%. So that means the return on equity of all their other activities was way less than 10%, similar to Wells Fargo.
Are HELOCs being used to buy additional properties, automobiles, and other things?
Absolutely. It's just mind-boggling to see how people are spending money on toys and stuff in a very serious recession. But if they have access to credit, they will buy the wake boats and the motorhomes and all this stuff. And when they were interviewed, the CEOs of the banks said, "Well, there's all this money in people's banks accounts," and they said they've been saving all the money. I don't believe that for a minute. I think what the reason all these bank accounts are so heavily, and it's true. I looked at the deposits, and the deposits are way up year over year in the banks. But it isn't because people saved any money that they had. A lot of people lost their incomes or had very much lower incomes. It was all of the government support money that came in. That, the wage subsidies and every CRB and there's so many acronyms I can't remember them all. All that money got deposited into the bank accounts, and people didn't spend all of it. But even spending a portion of it, they were buying more toys.
From March 2020 until now, were better returns made on real estate or the stock markets?
Well, so, to answer that question, we have to, so the answer to the simple answer to the question is the stock market did way better because the stock market hit a very low point in March of 2020, and it's recovered very rapidly ever since. So depending on what segment you're in, you had gains of more than 50%, more than 100% in some cases. So there's no way the real estate market can keep up with that. Even the oil and gas sector, which is facing a real headwind with this, this move to away from fossil fuels. A lot of those stocks are up 100%, 50%, 60%. Suncor, Canadian Natural Resources, all those companies have done very well from the bottom. So the stock market beat the real estate market by far. But when you look at real estate, people always use leverage. So if you take that example of 20% down and 80% loan, then you can have some pretty big gains in the real estate market. Not as big as the stock market, but pretty decent gains. This house is up 20%, but you're leveraged 5-1, so you've got conceivably you could have 100% return in real estate as well.
How are the U.S. and Canadian dollars looking?
So the U.S. dollar has been weak, and the Canadian dollar has been strong, and I don't really understand why. I don't know why the Canadian dollar should be so strong. It's 82, 83 cents. Of course, we haven't seen the housing bubble burst, and we have the worst stock market in the sense that we're in the wrong stuff. We're in cannabis, which hasn't done very well. We're in oil and gas, which until even allowing for the surge we've had in the last years, all of the Canadian stocks are quite a bit lower than they were 5 years ago when the oil price peaked and started to drop. And a big portion of the Canadian stock market, in fact, more than 50% of the profits of the stock market are now earned just by the lenders to the housing market. So if an observer was aware of all that, you would think they would be worried about the Canadian dollar and not wanting to put their money in there. But because their interest rates aren't higher than the U.S., the U.S. interest rates are actually in most cases a little bit higher than the Canadian rates. They're roughly equal, but a little bit of difference here and there. So usually what happens is people say, well, I can get a deposit, I can get a bond 2% in Canada, 2% in the U.S. I prefer the U.S. because the U.S. dollar is stronger, but it's been weak lately. So I think I don't fully understand why the Canadian dollar is so strong, and I don't expect the strength to last much longer.
Does the Communist Party of China now have significant influence in Canada?
There's a really good book that just came out. It's called Willful Blindness by Sam Cooper, and I just got it last night, and I haven't had a chance to read it yet. But my understanding is that book indicates that there has been significant influence, but I'll be able to, next time we talk, I'll have lots of information. Or the other thing you can do is interview Sam Cooper, because he's a very good investigative journalist who can answer that question better than me.
If you were Prime Minister, how would you get Canada's economy back on track?
Well, you think the opportunity is to, and this is really difficult in Canada because you've got the Alberta economy, which is, roughly 20% of Canada's economy is based a lot on fossil fuels. Not entirely, but primarily. And the opportunity that Canada has, I think, is to move into the renewable energy sector because, and this is not widely understood yet, but there's just a huge amount of demand that's going to be coming for the materials that go into things like electric cars and renewable energy and wind turbines. And Canada has got a lot of these, basic materials like nickel, copper, cobalt, manganese, rare earth metals. We don't actually produce any rare earth metals, but we have them. If we wanted to start, Canada could start producing them. And all of these things, it's just, the numbers are just really hard to believe. They're so big. So there's going to be a worldwide push to get more production of a lot of these things. So Canada's in a great position to do that, and that's what they should do. But in combination with that, of course, is you might want to get into the manufacturing of electric cars. So we've got a small and shrinking car industry in Ontario, and they need to move quickly to perhaps get a Canadian style business, not relying on Detroit to give us, little breadcrumbs here and there, but to actually have and there is a Canadian company that wants to make an electric car. They're going to call it the Arrow. So I think it would be a hot seller. So those are the kind of things that they do, but those are difficult to, usually governments, they go for change incrementally. Then what I'm talking about is more of a wholesale change.
What's new in renewable energy versus fossil fuels?
So this agency called the International Energy Agency, or IEA, has been putting out these annual reports for years, and they've always been viewed as sort of pro-fossil fuels, if you like. But they just put out a special report, came out in May, and they said net zero by 2050. So this is a pretty big change. Now they went through, I haven't got through the whole report, it's 220 pages, but they're going through all that needs to be done to get rid of fossil fuels in most segments of the economy, and which is what people are talking about leading up to the big meeting in Glasgow in November of this year, called the Conference of the Partners. And it's pretty radical. This is a big change. So to get rid of fossil fuels, everybody says, well, electric cars. Okay, so they're saying by 2040 there'll be no more new electric cars sold, and by 2040, 70% of all electricity will be produced by renewable energy. So that means getting rid entirely of coal and natural gas. And that would just leave hydro, nuclear, and solar and wind. And solar and wind would be the bulk of it, probably 60-70% of it. So in order to get there, so we're talking less than 20 years, and they sort of go through this in the report, just major changes. For instance, in your house, you wouldn't have any natural gas anymore. You'd have a heat pump, which would be run by electricity. And now the problem with heat pumps in Canada in the cold north is the way they get the heat is that they take it out of the air, but when it's minus 40 outside, there's no heat in the air. So what they have to do in Canada is we have to put in heat pumps that are in the ground. So if you go down about 10 or 15 feet in the ground, the heat is the temperature is generally more or less the same year round. So it is possible in Canada to have a heat pump. But these are the kind of changes that are just enormous, and it's just hard to visualize it happening in 2020. And the reports about in 20 years, or 30 years. But the report says that it can be done, but it's going to be very, very difficult.
Canada seems to be ignoring tidal power. We have the longest coastline in the world, and yet only the Bay of Fundy seems to be the only place where they're trying to do anything with that unused resource. Should more be put into tidal power? Well, the
reports I've read is that the potential for tidal power is not as great. So the thing with solar is that it's everywhere, even in countries like Germany and England where the sun doesn't shine that often. There's enough solar power to get enough energy for everything that you need to do, and it's so cheap now. So yeah, they'll go with tidal power. Another one is geothermal. Geothermal, there's some really good resources in Alberta, BC, but especially Alberta. You need to be drilled down several kilometers to where the really hot stuff is, and but the oil and gas industry knows how to drill that deep, so that can be done. But the bulk of it's going to be solar and wind. And as it turns out, actually, Saskatchewan and Alberta have really good solar resources. The sun shines a lot, and we don't have the solar. Alberta and Saskatchewan don't have the population, and usually, if you're going to do solar, you want to have it close to the population. So it's probably going to be mostly solar and wind because the costs have come down so rapidly. But there'll be everything. There'll be everything. There's even talk of and in this report, they're talking about nuclear, and there's proposals for small modular nuclear reactors. But that technology is new, and anytime you try to introduce a new technology in nuclear, it's 10, 20 years before you get it approved and built and everything. And that's assuming they could start right now. And that's going to be too late. So it's probably going to be, the bulk of it's going to be solar and wind.
More and more automakers are introducing electric vehicles. Do you think the battery producers are going to be able to keep up to the demand?
Well, Tesla's got some very ambitious targets for batteries. They're building one in Berlin. They've got one in Fremont, California, and one in Nevada. They're building a new one in Texas, and they've got one in China and Shanghai, I think it is already. So they've got about 5 or 6 locations. Detroit is finally coming around to building some batteries in partnership with some Korean companies. LG Chem is the big one. And there's a couple other, there's one in the southeastern part of the U.S. in Tennessee or something that's proposed. And then, of course, in Europe, they finally figured out that they need to start building batteries. And because batteries are probably going to be lithium ion, they're actually considered a hazardous material because of the fire hazard. So it's better if the batteries are built close to where the car is going to be used, right? So because if you ship a car with a lithium ion battery in it, then you've got a problem with shipping. So there'll be battery, they call them gigafactories, giga standing for billion, I guess. And they're going to build them all over the world, and there's going to be, by 2030, 2035, there's going to have to be some phenomenal number, like 20, 30, 40, 50 times the amount of batteries being produced that there are today. And of course, in every battery, there's lithium, which is quite plentiful, but there's also nickel, cobalt, manganese, and depending on what kind of materials they use. And then there's solid-state batteries, which are another whole story. And they also use lithium, but they use some other materials too. And the benefit of solid-state batteries is that they don't have the fire hazard.
There are predictions of gasoline hitting $7 US a gallon. Here in Vancouver at $1.56 a liter, we're already paying $5.93 a US gallon. Now, if gas hit that mark, what would happen likely to everything from the US dollar to interest rates to real estate and the markets?
Well, people tend to think of the price of gasoline as if we were in the 70s. So in the 70s, OPEC, the price of gas was like $1 a barrel or something, and it jumped to $10 a barrel in the first go around, and then it jumped again to $30 a barrel in the second go around. So from 1970 to 1981 or 82, it went up by many, many factors, but had a huge impact on the economy because the efficiency of the automobiles and the other vehicles was so poor. Like we were talking less than 10 miles to the gallon in a lot of these cars, right, and trucks and stuff. So nowadays, the new ones anyway are much more efficient. So it doesn't have nearly as big an impact. And of course, with the shift to electric, it will have even smaller impact as time goes forward. One of the things that the $7 a gallon, if it were to happen, would make a huge push into electric vehicles and buses, like diesel buses, diesel trucks, that sort of thing. One of the problems with the bigger vehicles, like planes and ships and big trucks, is the batteries don't work as well because the battery has to be so big. So there's a big push on for using hydrogen. So hydrogen would be feasible in those vehicles, and then be a fuel cell on board, and it would be used to make electricity, which would run the plane or the train or the truck. And so that would, anything like that, like $7 a gallon, would really give a big boost to hydrogen and to electrification of transportation.
Where can people follow you, and where can they buy the latest second edition of your book, When the Bubble Burst, Surviving the Canadian Real Estate Crash?
So, to buy the book, it's available in all the bookstores, plus Amazon, plus Kobo and Indigo and Chapters online service, plus the Kindle, the electronic version. I don't have an audio version yet. I'm not sure if we're going to do that or not. And as far as following me on a regular basis, on Twitter, there's quite a large following there. It's at HMACBE. And then people could sign up for a weekly post that I do called the Weekend Note. And it comes out on Fridays. And they can go to our website, MacBethMcLeodPartners.com, and sign up. Or if you look through my tweets, you can see the latest from Friday, and you can click on there, and then you can sign up that way as well, or just send us an email. So yeah, I encourage people to keep in touch and let me know if you have any questions or ideas. Lots of people contact me with challenging my views, and I enjoy that.
Hilliard, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's a portfolio manager and financial advisor in Edmonton, Alberta. His website, MacBethMcLeodPartners.com. You can find him on Twitter at HMACB, HMacB. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark and Hilliard MacBeth, and thank you for listening. If you have any questions for our guests or the show, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to Company Showcase, Larry.
Well, thanks, Jim.
Larry, a busy week for American Manganese. You had 2 news releases. Can you tell us about them?
Okay, the one on the 26th was to do with our recycling of a manufacturer's material, and we also put a comparison in there where the samples outperformed commercial grade cathode precursor purity, and that was to do with the amount of sodium, manganese, and silicon and sulfur. And we certainly were much less than the manufacturer's precursor material. So that was a feather in our hat. And, we strive to get this process done right, and because there's better rewards at the end of the day. And, to get what the manufacturers want, that's what we strive for. And eventually, when the governments wake up to the fact that maybe they should put some tougher requirements on recycling, we want to be able to meet that goal. And that's where we're going. And the second release was on the 26th, and that was to do with the benchmark. Zarko, our CTO, is presenting at the Benchmark Conference, and that is on June the 1st to the 4th of next week. So you can watch a presentation during the Gigafactory's Closing the Loop session on June the 2nd, 2021 at 6 a.m. Pacific Standard Time. So that was nice. The stock has performed pretty well. It's traded up to 99 cents today, and a decent volume. So we've come up all week, not all week, but for the last 3 days we've come up, and so that's an excellent thing. But Jim, you have some questions from a shareholder. If you wanted to ask those, I'll try to address them.
Yes, Simon wants to know a number of things. he was wondering if you might include how recycling could perhaps bring cost savings to the manufacturer. Could their potential savings be 10% from buying new material or even more?
Well, that's a kind of a hard question to answer because certainly we would get the same price as buying new, and but if we get all of our morphology down and everything else, that price could be significantly different. And because once you produce the salts and they have to go to chemical treatment, that's where the big cost comes in. And we're trying to eliminate that by working directly with gigafactories and save them that extra cost. I don't know. That'll have to be something that's negotiated, but until we know exactly what the costs are and how much we could reduce the cost to them, we can't really qualify what that number is going to be. But it's going to be significant. And one thing about recycling is, it's like same as buying new. You buy cathode material new, or you buy it from a process that we do. Without the morphology, it's going to be pretty much the same.
Also included in the question, would your recycling program reduce waste?
Oh, yes. It's a closed circuit, and nothing goes back into the environment, which is beneficial not just to the recycler, because now they can actually say that they're not putting nothing back into the environment. And we certainly get a lot of interest from battery manufacturers these days, and we're running through our material. But that's still, we haven't solidified any type of a deal with them, and but we're in a position to do that very shortly. So nothing goes back into the environment. It's closed circuit. There's nothing goes into the air. Nothing goes into the watershed. It's all reused and runs through the plant. So the water is saved, and we keep reusing it over and over again without anything going back into the environment.
Where would AMY fit into the supply chain?
Well, we would be one of the suppliers, like a battery manufacturer, and that's where we'd fit in, and that's why we're trying to make a finished product. And I have to tell you, the finished product could save companies a considerable amount of money, but they got to pay for that too. I mean, this is not something that we give away, and because there's a cost to it. So, but it's got to be very appealing for them.
Now, what about the quality that the recycled material would have? Would it be better than new?
Well, from tests that we've done, we've shown we've turned out a better product than the cathode manufacturers have, not manufacturers, the cathode suppliers have come up with. In the latest press release, it showed, I just went through that. It showed the amounts of contaminants that were in the solution. Not that they stop a battery, but I'd have to say, based on those results, that we're much more pure.
Larry, for people who are brand new to American Manganese, what's the company all about?
American Manganese is a critical metals company that developed got involved in manganese back in 2007. And the reality is that the price of electrolytic manganese metal dropped all the time we were doing a pre-feasibility back in 2011 and 12. And eventually it ended up with about an 11-year payback, which was a non-starter. And so we put it on the shelf. But I just saw an article today where the price is back up to almost where it was when we started the pre-feasibility study. But I caution everybody that can change because this whole solution, this whole supply chain is supplied by China. And if they hit a road bump, then the price can go up or the price can go down. So, but it's very encouraging to see that manganese has got such a bullish stand, at least this week. So that's a great thing. We've taken this process and developed a recycling program that works on all the cathode metals, at least the ones that we've reported on, and it is, the cornerstone of our processing. So we couldn't be happier with those results, Jim. And just not to forget about the other products that we have, like gold and copper. They are definitely going into bull market territory. Certainly copper is, and it looks like the gold price is finally may stabilize and move upward. And so we've got some nice projects in our company, but I want people to remember that 95% of our effort goes on the recycling. But we don't want to ignore we don't want to throw the baby out with the bathwater, and we will be reporting on events in the manganese market, and I'm hoping to do a little work up on our manganese project because we were going to spin it out. We had done a few things, put a few things in motion, and so you got to bring these things along. If you're going to add value, you got to spend a little bit of money and a little bit of effort, and that's exactly what we want to do: is add value for the shareholders. I'm one of the largest, and so I like to see added value right down to the smallest shareholder, and so that's what we strive to do.
Larry, where can people get more information, and where are you traded?
They can go to our site. It's very transparent. I went through it yesterday, checking out the old stuff that we had done on manganese. And there's a lot of information there, and the pre-feasibility studies and everything else. They have to go back to 2011, 2012, and we've got a lot of potential in what we did there. And but it's all on the site. We are traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. And we're traded on Frankfurt under the symbol 2AM. You can get information from that site by going to AmericanManganeseInc.com. You can phone the office here at 778-574-4444, or you can send me an email at lreaugh@amymn.com. If you need anything else, please don't hesitate to give me a call.
Larry, thank you so much for the update.
You're welcome, Jim.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on May 28th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.